In this video, I'm going to discuss the treatment of the sale of a rental property for tax purposes, and I will also point out some IRS resources that can be referred to for additional information. In general, I'm talking about a rental property is one that you've owned for more than a year and you rent to tenants. And when you file your tax return at the end of the year, you file a Schedule E in which you recognize the income and expenses related to the property. This is considered a trade or business, having a rental property. It's also considered a passive investment. And for the sale of rental property, we'll see in this publication, it is specifically defined as not a capital asset, and as a result, it is what's considered a Section 1231 asset, and you must follow Section 1231 rules. It may end up being treated as capital gain, or a portion of the gain may end up being treated as capital gain. However, there are additional rules starting with Section 1231 property. On Form 4797 is where the gain or loss is calculated, which is step one when you're dealing with your sale of rental property. The sale price is fairly explanatory. There are very specific rules for what can be included in all of these. However, the cost basis is not simply what you paid. In general, it would be what you paid plus any other fees, related costs, also any improvements you did to the properties or remodels that were not deducted as expenses on those Schedule E's increase the basis, so you add them to your cost. And then a critical piece in the sale of a rental property is all the depreciation expense that you took on your Schedule E's attached to your tax return. You have to add up all depreciation expense that has been taken on the property, and then you decrease your cost basis by that amount. So sometimes you can end up with a gain when you thought you had a loss. So first, dealing with the gain side, if you have a gain, Section 1250 rules apply. And basically, Section 1250 rules are just recapturing the depreciation expense that you've taken. So that total depreciation expense that you have taken on all of your tax returns over the years, to the extent that your gain is greater than that, you will only take the depreciation expense, or if the depreciation expense exceeds the gain, you would simply take the gain amount taxed at the taxpayer's rate based on how much income they had. However, that is limited to 25%, and then any excess gain after recapturing that depreciation expense they took is considered capital gain, taxed at the preferential rate of 15% or 0% if you're in a lower bracket. Also, one thing to note, if you acquired the asset a different way other than by buying it outright, there are very specific rules for calculating basis for gifts or Section 1231 exchanges or involuntary conversion, etc. For more information on Section 1231 transactions and depreciation recapture, you can refer to publication 544. So if you had a net loss after subtracting the sales from the adjusted basis in the property, then in general, Section 1231 losses are only deductible from Section 1231 income. They can only be used to offset it. However, we said that rental property is passive activity, so that loss is calculated on Form 8582. And there is one large exception to the rule that Section 1231 losses are only used to offset Section 1231 income, which in general is rental property. There are a few other specific, more rare situations that qualify as Section 1231 transactions. However, the exception for rental real estate for individuals with active participation is that they get to deduct $25,000 of loss, if they have it, of passive activity loss, on the page 1 of their 1040 tax return. And that amount can create a loss, an NOL, if it exceeds all of your income from other sources. And also, that $25,000 deduction is phased out if your modified AGI, which is a specific calculation, is between $100,000 and $150,000. And this $25,000 deduction of allowance is disallowed over $150,000 of modified AGI. If you had this same passive activity loss special allowance applied for while you were renting the property also, if you had a loss, you could deduct up to $25,000 a year from ordinary wages, any income. And some other things to be aware about. The at-risk rules also may apply, which are discussed in Form 6198, and the instructions are located here also. But basically, if you weren't liable for the property, so if you had some sort of fancy ownership, or you were not going to be liable for the loss of the property entirely, then some of these rules may apply and affect your gain and loss calculation. And all of the instructions, the IRS has instructions for forms. The publications and instructions come in a web template where you click on all of these topics, or a PDF version for your convenient viewing.